Well, welcome to episode 36 of Distressed Deals Decoded, everybody. My name's Patrick Butler. I'll be your host today, and I'm joined by my two esteemed colleagues, Mr. Steven Schiller. Steve, say hi.
Hello, everybody.
And Mr. Juan Nicasio, our ultimate investor.
Let's go. Hello, everybody.
Awesome. So today we're diving into yet another issue about the emerging real estate opportunities that exist in today's market for folks like you and us, for real estate investors and real estate agents alike. The topic today is how proper underwriting turned what we thought was a standard vanilla short sale into not one, but two six-figure opportunities for two different investors. So let's get into the nuts and bolts of this thing. We're breaking down a deal that looked like a very standard short sale. We get a lot of these. In fact, sometimes we love them when they're just standard short sales, right? One lien, easy to negotiate with, in and out the door, bing, bang, boom. Homeowners in distress, property needs significant amounts of work, just your standard ugly deal. Debt needs to be resolved, etc. But that's not how this deal turned out to be once we started doing the underwriting. We discovered something that completely changed the economics, not just for ourselves, but for the two clients one that brought us the deal, the other one that was brought into it. This property had the potential to produce a six-figure win for both the wholesaler and for the fix and flipper. So let's take a look at this thing. Ultimately, we had one investor who identified the property, controlled the transaction from start to finish, had the homeowner engaged, right? Very important. We know that's part of our checklist. And the second one was the fix and flipper who could take the property through the reno and all the way to receive its full after repaired value or ARV. So one of the lessons learned in today's topic is don't just think everything's a standard short sale, or as we've talked about, that it's just going to be a fire sale in and out the door. It's got to go through the underwriting process. So, one, I think you were actually partially responsible, if not fully, for getting this deal over to us. Tell us, how did it start out? We got you on mute, my man.
Sorry about that.
That was the
So,
best part.
as yeah, it was the best part. That's it. Well, it always starts as a short sale. It may appear from the surface as just a standard short sale, like you mentioned earlier. But we'll keep it very, very simple. We have to number one, a wholesaler has marketing that he or she is doing. And through that marketing channel, a lot of times you run into scenarios where you just don't see the equity play. You don't see where you can extract sufficient amount of an investment deal. But in this particular case, there's a couple things that stood out. Number one, it was a distressed home. The property did need substantial amount of renovation. There was a mortgage debt, and from a wholesale standpoint, typically you're dealing with properties that have more than a 30% equity in the deal. This one, on the surface, it looked like there was way too much debt and it was a potential short sale situation, like what was brought to the table from the wholesaler. The investor looking at the opportunity, right, as an acquisition opportunity, that's where things got very, very interesting. From a 30-foot view, nothing looked out of norm, right? What we discovered here in the approach is where we were able to look at what the property was worth today in its as is condition, right? We needed to figure out who owned the property and what the lender would take on the particular debt that was already on the deal. We needed to figure out, can we buy it low enough to make any money on this particular deal? Those are all really valid questions, but sometimes it's not enough just to go through those little preliminary questions to see if it's a deal or not. You may have to dig just a little bit deeper in understanding through the underwriting process. Is there any hidden equity? Is there any other negotiation tactic that we can utilize in order to extract value? Do we even have the right debt on the mortgage? There's all different factors that we needed to go through with a fine-tooth comb so that we'll be able to find that type of opportunity through our underwriting process. And here at ARA, before deciding whether it's a deal or not, do we believe we have anything here is one of the first things that we analyze before we go any further and getting our hopes up. So there are a few red flags that came up on this particular deal that I'm going to let Steve kind of chime in there because he went through the deeper underwriting and found the additional layers. So Steve, what were some of the first red flags that you found in this underwriting that was a little bit different than what we normally handle or come across on a consistent basis?
And before you say anything, Steve, for everybody watching this, I want you to understand Steve is like the mortgage whisperer. I don't know if you remember the movie from 20 years ago with Robert Redford. He was the horse whisperer. Well, Steve
True.
can see things in these files that the average human being just can't do. So, Steve, we're excited to hear this.
Yeah, this was it was unique and an interesting one. So when we got the details of the information, there was a small red flag that popped up that was curious to me. The balance on the loan that we got, because we actually got a payoff from the homeowner, was in the mid to upper 400s. The as is value was in the mid 100s. That's a pretty big gap. Doesn't happen often. So, as we always do, we try to investigate to ensure something wasn't missed. Usually don't get a 400 plus $1,000 property or loan or 100 for 150,000, 160,000 without significant damage, significant issues. And even then it's not common, right? Most homes, a $400,000 home, even with really severe damage, 150 to $200,000 off. So this was odd. As we looked into it and we started digging into it, we found out that this was actually a rehab loan. And we contacted the servicer and asked them, hey, on your payoff, it didn't show the rehab information. This house wasn't rehab. Give us some information back. Long story short, and it was a long story. We found out that at first the servicer did not know that this was a rehab loan. It wasn't in their system right. The data wasn't right. So why was that a big issue? Well, in a rehab, you hold money in reserve to fix the property and it's released over the course of time. So the issue that we ran into as a rehab loan is a government FHA backed loan. The main issue there is we didn't want somebody going out to do an appraisal. FHA always does an appraisal on a sale and coming up with this exact problem we're coming across right now. How is this $100,000+ home? Why is our principal balance 400? What's going on? No, we're just not going to sell this. We'll figure this out later, right? That's generally what servicers do when they come across errors. And we didn't want that to happen, especially on this deal because the ARV on this, and this is the big thing, drum roll please, was over $500,000. So as we talked about last week and in previous podcasts for everybody, when you have a nice gap in your ARV, it usually means good things for people. But we weren't going to be able to move forward with this one until we got the information right at the servicer side so that when they do process the sale, they can underwrite their part correctly. And so that was the part we noticed that needed to get fixed, which is what first part of what we did.
Amazing. So, as we look into this, then some mistakes that could have happened from a less seasoned crew might have been get the offer in from the investors, submit the deal. And what I heard was the lender didn't have all their ducks in a row on the loan. So the odds are probably stacked against that deal ever going to closing. It would have just either somebody might have figured something out along the way and didn't say anything to anybody, or they're just like, I don't know what's going on here. This will just be
Well,
one that doesn't make it.
well, and this does happen quite often in our industry, in the mortgage industry, which is a servicer, an investor, they don't know what the hell went on with the property, and they just try to foreclose out the problems.
Yeah.
It doesn't really fix the problems, but they try to foreclose them out, figuring, oh, if nobody contests this, we're good, which is accurate in most cases.
Got it. So a lot of the things, again, when you look at a standard transaction, Juan, you said it earlier on, as an investor or even as a real estate agent, I say that because oftentimes the real estate agent looks less into the economics of the deal. They want to earn their commission, sell the property. If it's a short sale, I understand how that works. I'll hire asset res. But what really was going on? So things that need to be considered was all the usual suspects. Who's the owner? Who's the lender? What type of a loan was it? And Steve, I have to hand it to you. Your red flag that popped up, not everybody's going to see that. They're not going to catch that little nuance there right off the bat. And to your point, that ARV was high enough that really prompted something to come up. Now, as far as why the servicer's records were inconsistent, any idea what may have caused that to happen? Or is it, do you sell the loan 3 times and it gets lost in the
Yeah,
shuffle?
yeah, it's a combination of all of those, right? It's rehab loans are not as common as
Yep.
regular loans. Um, for whatever reason, when it got transferred to the servicers, it was just human error, right? Somebody just missed that it was an FHA rehab loan. And so the issue was that they added the nuance of it is they added the 200 plus $1,000 set aside for the rehab into the balance, which is correct, but they didn't put the escrow balance of the 200,000 anywhere in their they just missed, somebody missed it,
Got
right?
it. So that
And
was the money, and it was nowhere to be found.
right, so that comes off the balance. So instead of the balance really being 400 and something, it's really 200 and something, which when you balance it out against a distressed property is not as bad as the opposite. And but they need to get that correct, because right on the backside, maybe we'll do this one of the podcasts, on the backside of what servicers are doing, right? Insurance and claims and all this other stuff, they've got to get it right. Well, if they can't figure out their numbers, they're not going to move forward with lost mit. Again, it's faster. Foreclose, figure it out later, and we'll do something later. The last thing they want to do is short sell it, because it has a completely different set of guidelines and what
Mhm.
happens. So that's their answer. We didn't want this to go away.
So ultimately, then the 200,000 that was out there in limbo someplace, it was never utilized. None of the rehab work was done. So essentially, the lender was able to take that off the balance of the loan. Like, oh, okay, we need to. All right, so now we have a different model. So the reveal, then this isn't one deal; it's 2 deals. And Juan, somehow we left you out, so feel free to jump in here. You've got the next segment, but so how did that all shake out? The 2 deals.
Yeah, I'll go in and I'll tag team here with Juan, because he's the investor. So the first part, which was getting the valuation done, when we went and got the value from the servicer, they did their appraisal, and the appraisal came in the mid hundreds. Um, it was a well done appraisal for the property, the way it looked. The investor in this situation knew that the ARV, because they did a good job of underwriting, the ARV was in the 500s. So because there was that substantial difference between the two, now it was a matter of, how do you structure this deal so that you can get everybody to participate? So here's the first part is, I'll let Juan take this part. So from a wholesaler's position, it's a little different because it's a short sale. So what does a wholesaler have to do in order to get this first part of the transaction done?
Well, number one, they need to understand that after repair value, they got to find where that value is going to be in order for them to work their numbers backwards. Because otherwise, you can't, be able to present this opportunity to a fix and flip investor, investor number two, right, where they can see the upside. Our job, on the wholesale side is, okay, what are we actually looking at? What are the comparables? What can we extract? Where is the value at, right, on this particular deal? And so from the wholesale standpoint, well, they needed to know their clear exit strategy on this out of the gate, right? That you can extract additional equity out of the deal with everything that you found was a plus. But right out of the gate, there should have been a due diligence and understanding what the exit's going to be so that you can work the numbers backwards and leaving enough margin for an investor to say, yes, you know what? If I'm able to purchase this property at X price, knowing the level of renovation, well, I'm game. I'm ready to go, which gives a wholesaler confidence to go through this process with ARA. And then what we could potentially do on the wholesale side is, okay, let's go through the process, see if we're able to get that value and prove to the servicer that this is the new as is value, and then create a small margin from there. Typically, a small margin is we don't come across double six figures on a deal like this.
No, and I think again, it's something we keep preaching and we'll keep preaching and we'll continue to talk about is you don't come across these deals unless you work them,
Right.
right?
Sure.
I mean, the general avatar is you have to know your ARVs and then figure out the as is and figure out what the spread is. The exit will come right out of that, whether it's smaller margins or larger margins. But if you have enough room in there, right, that's what works. Everybody's looking for these six-figure, 6.5 figure, you know, deals that just usually are not there. They're smaller, right? They're going to be
Yeah.
20, they're going to be 30,000, 40,000, but those are good deals.
Yeah,
And the more you do, you're going to come across the six-figure ones.
that's
That's
right.
correct.
And and sometimes it's funny. It's like anything in life. Sometimes they come every now and then. Other times they'll come back to back to back. And you could have a really
Yeah,
great year when you get three of these things at one time.
right.
And we've seen that. So,
Yeah.
the
So
more this distressed market expands, the more of these opportunities are gonna show themselves for sure.
so from a wholesaler's perspective, here's where things are a little bit different. You can't assign a short sale.
Correct.
So the first part they're doing is they're going to have to figure out how to close on the first part of the transaction.
Sure.
The second part to it is their quote unquote flip, right? The flip of the sale. And we don't handle that piece. That's handled outside of everything we do. But again, it's a matter of going to your resources, finding the people who will then turn into the second part of the transaction. And that's how you make a six-figure deal off of a short sale as a wholesaler.
Correct.
Yep.
So that's part one. Now let's go to part two. Let's flip it to the fix and flipper. So
Correct.
so now the fix and flipper, what are they looking at on this one? How are they evaluating this, and why was this a good deal for them?
Well, the ARV ended up being the reason for the deal, right? Like the wholesaler, if they do what they need to do, where it's like, hey, you figure out, you have yourself a good six-figure deal, even if it's a five-figure deal, you have enough margin, figure out a way how you're going to close on this deal, right? You already know that there are other potential buyers, like the fix and flip investor, that is willing to purchase this property. You've done all the work. Your value add is that number one, you did the marketing. Number two, you did your due diligence. Number three, you went through somewhat what the painful negotiation process and timing to get the new value, where the fix and flip investor literally comes in at the end tail of everything, where they're now picking up a really good property at a great price, right? And so the wholesaler, to finish off the wholesaler, they need to figure out a way, whether it be hard money or it would be transactional funding, which a lot of different, non-traditional institutions will lend on those type of deals. So you're able to close legitimately and legally on that short sale. What you do thereafter, that's totally up to you. The bank only really cares about you closing on your first transaction, your first agreement, your first approval on the actual short sale approval. Thereafter, if you have an opportunity, that's where you are able to bring it to a fix and flipper. What is a fix and flipper looking at? Number one, how easy is it to acquire this property or not? Do I have to jump through a ton of hoops? How much money do I have to spend? Are there any legal fees? Do I have to, take it and typically on a short sale, you don't have any post occupancy. But, what do I have to jump through? What hoops am I looking at when I acquire the property? Am I acquiring this thing with liens and violations, right? those are the type of things that as an investor you're looking at first. How to acquire the property, how you would be acquiring the property. Number two, am I willing to fund this deal, and how would I fund the deal, right? Am I funding the deal with my own cash, or am I getting hard money so that I can start doing my numbers, right? Managing my carrying cost or my renovation cost. That is number two. Number three, completing the renovation. Is it going to be a large team, small team? How long am I going to be projected to be in this deal? Is it going to be a 3 month renovation? Is it going to be a 2 month renovation, 6 month renovation? What am I doing with the property to see if it's even worth us making an offer as a fix and flipper? Managing the construction, of course, like that's the babysitting job that you have to put in there, because it goes in right into the carrying cost and everything else, the minutia that comes in the fix and flip world. And then obviously taking the risk on the market. Will the market, from the time that I acquire the property to the time that it takes to renovate this property, which with this one required a substantial amount of renovation. We're talking about $200,000 in renovation. That is not a light task. Okay, typically for a $200,000 renovation, you're almost damn near bringing everything down to the studs. You got to get permits, you got to get inspections done, you got to bring this thing back to market. So that might be 6, 7, 8 months of carrying costs, and the market can potentially shift on you in those 6 months. So that right there is something that you as a fix and flipper need to take into very, very strong consideration and be extremely conservative depending on what market cycle you're in. Right now, market's a little bit on the weird side, where it could be a hit or miss in my professional opinion. And then ultimately, the resale, what is the resale price that I can go ahead and sell this property for realistically while making a profit? They're taking on more risk, but also they're pursuing this in a different lens. For example, on this particular case, it makes all the sense in the world. The acquisition on this, what was the final number, Steve? It was like the wholesaler would sell it to the investor. I think it
It's the
was
mid 200s.
in the mid 200s, right? So 250, and then you have, they call it about 150 to $200,000 renovation cost. Financing costs are going to be somewhere around 1% a month would be the carrying cost on something like this. So if, again, and there's so many different ways to kind of chop up the numbers, but if the fix and flipper is getting 100% financing for the purchase and the renovation, well, then you're looking at 1% a month on like close to $450,000. If not, then if they're putting in the rehab, they're only getting a 1% loan a month on the purchase of 250. Closing costs, you're going to have somewhere between, call it, on the worst end is going to be somewhere between 8 to 10%. But what makes this deal the sexiest is that the projected outcome will be you can put it out on the market for somewhere north of $550,000. That will project you a little bit over 100,000 on the resale. So it's a big, big opportunity, because the average fix and flipper makes somewhere, and I know that some people are probably gonna be up in arms in the chats, the internet, or what's it called, the doom scrollers are gonna be like, I don't know how he does his math. Listen, the average fix and flipper, by the time that you do the entire renovation, you calculate all the holding costs, the time of acquisition, to all the way to putting cash in your pocket, they're making somewhere between $25,000-$45,000 a deal. Those are the hard truth. So to find a deal that you make a bit over $100,000, 80, 100, 120, 150, is like doing two freaking properties. So that to me is a very, very big, opportunity, where I'm going to take the risk on these type of deals, right? Like, those are the juicy ones. Those are the ones you attack. So you just got to make sure that You have enough room in the lending that you have enough time to do your due diligence once you got the that approval, making sure that all of it pieces out together, that the wholesaler is not taking advantage of you as well, right? That you can negotiate a very strong price, and then just obviously be able to build that relationship with people that can go through that type of work. It's not easy to acquire the property from out the gate. So from the investor standpoint, I think this is where it makes sense, to have a win-win. It was really a win-win-win situation, right? Because the homeowner done with the property, right? It's off their hair. Wholesaler made some cash. Bank also made whole on whatever debt was there. Everything was cleared out, and now the fix and flipper is able to make a nice profit on something like this. So, Steve, the real value, where was it created?
So, and thank you for all. I think that's really good one. The value for my 2 cents out of this whole thing really came out of right from where we started, figuring out what the issues were from this, right? Um, the short sale part added to it, right? I think it was more additive to this deal than anything. Really, in this case, it was the underwriting. It was understanding that there was an issue with what was going on the servicing side, identifying what that issue was, being able to fix it so that when the short sale, right, the short sale added to that, making this whole thing absolutely a great deal. And then
Sure.
once you get the short sale approved, now it becomes this huge adjustment on everything, right, for everybody. So now everybody can make their money, right? So it's the servicing issue, the rehab reserve issue, just the underwriting. I think that for the most part, Patrick said it early on, and I think it's right. I think most people would have just dismissed this and just said, eh,
100%.
and would have wasted the time, and it just would have rolled into a nothing, right? You put
Yes.
$100,000 offer with a $400,000 UPB, and you're turning around and the servicer's saying, "Oh, there's all sorts of crap," and they walk away. So to me, that's where I think all the value ended up being made in this deal was that one little thing.
Yes. I agree 1000%. There's no way that the wholesaler would have been able to close on that deal. And the investor wouldn't have had enough wiggle room to be able to take on such a task. If you didn't find that equity gap, there was no deal.
This reminds me of another industry altogether, and it's being a pilot. I'm not a pilot, but what I know about being a pilot is they don't take shortcuts in most cases, right? Pilot has their checklist, pre-flight checklist. No matter if they've been flying for 2 years or 25 years, they go through that checklist. And Steve, your team could have just as easily taken that file. Oh my God, here's another short sell. ARV's 500,000, 100 offers, not going to work. Forget it. We're done. But you go through the checklist. You say, look, the investor came as one of our clients, one of our members of our community. Let's go through the underwriting process because that's part of what we do. And every single time we have one of these podcasts, it reinforces that, man, they're out there. You pop that oyster open, hoping to get a delicious Apalachicola or Florida oyster, and there's a pearl inside of it. Well, holy cow, I didn't expect that. But you got to open the oysters. In that bushel somewhere is pearl, and you just have to open them up. And the good news is, if you like oysters, you can eat the oysters as you go, and life is good. Everything else is gravy. So, the lesson isn't just always poo-poo something. It's not always going to be the same transaction, but the opportunities are there. You see it all the time in today's marketplace. You've got to underwrite it, and better have somebody like Asset Resolution Advisors underwrite it for you and with you. We can do it with you, teach you. We've got so many different models, whether we train you to do it on your own, we do it for you, we do it together. We are very flexible here. The underwriting was the key to everything. So folks, if you're dealing with any distressed properties, if you're dealing with a troubling transaction, short sales, probate, bankruptcy, you know where you need to go. Contact us at Asset Resolution Advisors and let us work with you on this, at least for the first couple, till you learn the ropes, right? And you'll
Mhm.
find that it's worth every single penny that you don't necessarily pay until the very end, right? We're kind of like Morgan and Morgan. We don't win unless you do. And so, once again, if you like what you hear, subscribe, like us on our YouTube channel, share it on your own social media. But more than anything, reach out to us at Asset Resolution Advisors. So before we stop this wonderful session, I'm going to ask my teammates, is there anything else that we need to cover before we say goodbye to the audience?
Oh, no, I
Submit
think
your
we're good.
deals.
Oh,
Just
yeah, get
submit
out
those
there,
deals.
find those hidden gems, folks. They're everywhere. Till next time, we'll see you soon.